inside the options play software, we will highlight this for you, okay? So this example was not that long ago, but Apple was at 196. It was up 95 cents on the day. And here is our days to expiration. It will tell you where the days to expiration is, and it will tell you out of this time premium, what is the implied volatility for that option contract. And once again, that is the mystery. And if we get a time, maybe I'll jump forward to my couple slides that I added to this presentation. But in all of our examples here, we have three different examples. We have the 195 strike, which is in, the 205 strike, which is out, and the 205 strike, which is the most at the money. That's going to be, okay, we don't have an at the money. And then we're out and we're out. Okay, so 205, 195. Once again, I thought that's at, out, and further out. All right, so let's look at intrinsic value versus time value, and let's do just a little bit of analysis here. All right, so if the market is at 195, we're talking about a March 15th call, it's 50 days to that expiration date. We would see that this is trading for $7.10. If you bought one of it, one call option, it would be $710. We take the price of the call option, 195, and we subtract 195 from 196.13. And you see that this option contract trading at $7.10 has $1.13 worth of time and $5.97 worth of time and $1.13 worth of intrinsic value. If I exercised and sold, I would get $1.13, but that would also mean I get the stupid award because I could have sold it on the market, right? And captured all of this time premium. So that leads to the discussion that I had about exercising, trading in and out of the position, and letting the option expire worthless, right? Most of the time, people don't want to exercise and buy the stock if there's time premium in that option contract, because it behooves them to sell it on the options marketplace. Now, in this instance, we're way out of the money. No intrinsic value. 205 is quite a bit higher than 196, but it's a 50-day option contract, and the marketplace has determined, based off of the risk factor or what the marketplace is implying the volatility of the stock to be over the life of the option contract, that's worth $2.61. 50 days is worth $2.61. Here's the cost. If you bought one contract, $261. If you bought two contracts, it would be double that. That's straightforward. All right. And then lastly, we got the 210, which is even further out of the money. Since it's so far out of the money, it's going to be trading for less. And the further and further I go out on the scale, it's going to be trading for less and less and less. And then we would get to Veronica's question. Well, if what if it was trading, what if you're buying the 250 strike call? What would that be trading for, Veronica? Answer is zero. Why? Because you're so far out of the money on a 50-day option contract that there be little benefit to owning that contract. The probability of it getting to the strike, and that's an important thing here too, by the way. Another way to say implied volatility and what this implies is if you have higher implied volatility, there is a higher probability that the stock is going to get to this level. That simple. If we stay in the mega cap tech world, which stock do you think is more volatile? Would you say Amazon is more volatile, or would you say Apple is more volatile? They both announced earnings last week, actually, in the real market world. What do you think is more volatile? Well, I'll just cut to the chase. I'm sure most people will say that Amazon is more volatile. AMZN is the symbol. Thank you for that. And yeah, that's true. So guess what? An option contract that is, and I'm just going to round off here, that is 9 points out of the money, like this option contract is, on Amazon is going to cost you more. And why is that? There is going to be a higher implied volatility because the stock has a tendency to be more volatile. And that implied volatility increases the probability that it might reach that strike price, and hence the reason why you would pay more for it.